How do you see the closing out of 2022 and the ushering in of 2023 for the global economy and for these big headwinds that we have faced this year?
Yeah, I mean, we're so close to year end, right? And I know everybody's talking about the Santa Claus rally, but I think we need to look past that. I think we'll probably see firmness through year end. And yet, I think a lot of volatility is in store for us in January to start off the new year. And I say that in part based on the posture of our short-term indicators, which, as you can imagine, are pointing lower, very similar to after the summertime relief rally. We also had resistance levels intact at the 200-day moving averages for many of the major indices and also individual stocks. We have a short-term breakdown in Apple stock, which of course is a bellwether. And the VIX is set up in a way that we can harken back, unfortunately, to 2008, where it actually preceded a pretty massive volatility spike. So we're bracing for more risk to start off the new year. And yet we think that that kind of downdraft that we are expecting, where 3,500 is retested by the S&P 500, could actually give way to some kind of major low.
It's notable that you're among the many guests that I've talked to on CNBC in recent weeks who keep bringing up gold as a safe haven.
Right. I mean, it has really turned the corner of late. We've had intermediate term momentum improve there, reversed a downtrend that had been in force for some of this year. And also the relative performance has really turned the corner as well this year versus the S&P 500. There's a gradual uptrend in the ratio of gold to the S&P 500. And that to us suggests that as we see this kind of volatility expand, that gold will become something that draws people in, and other precious metals would apply there as well. When you look at the long-term oversold reading that gold is reacting to, it's a bit higher conviction than the longer-term oversold reading that we're seeing in equities. And that's because gold is in a range as opposed to a downtrend. So that's when those oversold conditions tend to be a little bit higher probability. So we are looking for gold to clear sort of near-term resistance in the coming weeks here for an initial upside target of about 1,900 per ounce.
Let me drill down on some news that we just got late yesterday after, for instance, Nike reported earnings. We are seeing shares soaring on the back of their second quarter top and bottom line beats, but higher costs squeezing the margins, inventories up year over year. They were slightly down from a quarter ago. It looks like they're making slow progress on managing inventories. The thing that I really thought was notable here, Katie, is that Nike said in its digital segments, it's seeing so much progress because customers are signing up to be members. This idea that you would be a member the way you would for an airline rewards program is really notable.
Right, and it's nice to have some good news and some favorable reactions out there because we haven't seen much of that of late. And unfortunately, though, Nike stock has really been a longer-term underperformer. And with this bounce likely today on the back of this news, Nike is going to come into resistance on the chart. It's around 118.5, so slightly below based on where it's bid up this morning. But it creates a proving ground for the stock because it is in a downtrend, very much like the broader market. And what I feel is that the top-down influences are so strong here that as much as you can make a fundamental case, there is that challenge, right? Even if, folks feel confident in Nike's prospects, if it's a downtrending market, it just creates that much more of a hurdle for Nike. So that resistance, I'll be really interested to see if it can get through.
All right, shares up, though, right now, more than 12.5% in the early trade. Stock 2, we're watching shares of Tesla. This has been a brutal year for this stock, closing down another 8% yesterday. Tesla is set to open this morning with a market cap below that of ExxonMobil, below $150 a share. It would be the first time in 2 years that it's hit that level. Tesla's on track for its worst month, its worst quarter, and its worst year in history. Katie, does that mean that this could be an opportunity to get into Tesla and have a historic buying opportunity?
I mean, it certainly could, but there is no support right in line. So I think we have to respect that. We've seen a series of breakdowns for Tesla, and the stock clearly exhibits negative momentum at this stage still across all time frames. So I wouldn't want to be the first one to try to pick up the shares at low levels. I'd rather see Tesla enter some kind of basing phase or bottoming process. And what that means, it sticks an initial low. Maybe this is it, maybe it's not. And then it ends up seeing a series of retests of those lows. And then with that, we start to see some improvement in momentum, meaning sort of like higher lows in our indicators, even as price just goes sideways. So we're going to wait for those positive divergences to unfold for Tesla. And that might mean we don't capture the absolute low, but something closer to that with a lot less risk. I think the risks still are very high here. Also incorporating those top-down views.
The mega caps have received so much attention for being under so much pressure in 2022. But I looked through your predictions based on the technicals here, and it looks like you think small caps end up being the laggards going into the new year.
You know, it's funny because usually you would expect small caps to outperform at this time of year. There's sort of like a tax loss selling rebound at times. They call it the January effect, and yet we haven't really seen that manifest itself as of yet in the markets, looking at the ratios of things like the Russell 2000 index to the S&P 500 index. So we are looking for small caps to sort of remain out of favor near term, and yet we're also looking for underperformance by the mega caps. And I think that's even more important because it means that the downside leadership is concentrated and really impacting market sentiment, especially as it pertains to Apple's stock. And if you look at Apple's stock, short term it has a breakdown, and if you zoom out and look at the monthly bar chart, so a very longer term view, you'll see it still looks quite toppy. Conversely, the small caps for the most part had been trending lower for nearly 2 years. So some of those small caps collectively are a bit more oversold. They have better support discovery. And even though they look lower near term with the broader market, they could be closer to a low than some of the mega caps.
For how long should investors keep their seatbelts ready to go and be prepared for this bumpy ride to continue?
Well, I've been saying to our clients to be hedged through sort of the end of January, perhaps middle of February, as a targeted level for this sort of volatility spike or event that we're anticipating. But listen, we always change with the market. We're constantly watching things, and we simply want to stay on the right side of the market. And if the market changes, we'll change with it. If we had to look at our indicators to suggest when a low is more likely, it would not be until maybe March or perhaps April in terms of just a long-term indication of that oversold reaction.